Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, we have a government shutdown that's imminent, probably going to happen this weekend, and we're going to go into next week with partial government services. Is that really bad for our portfolios? We're going to talk about that, and it's not as bad as you might think. Let's dive in.
Trade Genius.
All right, Bob. So everybody's kind of been buzzing about this government shutdown. Maybe that's why the markets have dropped today, pulling back from that initial bounce that we've got. What do you think?
Yeah, this is one of those classic sell the rumor, buy the news kind of a approach. Historically, the government shutdowns have a lot of drama. And then at the very end, they resolve it. And then all we do is really push money forward or push money back a couple weeks. So we actually have data that shows you that all the government shutdowns, they last on average 2 weeks. Initially, you get a little bit of a push down in the market, like 0.5%. And I think I have that chart, Phil. Once it's passed, actually the market's up 4 or 5%, 2 to 3 months out. So, and why? It's so obvious because, the government drugs are coming in, right? So more liquidity, more spending pushes the market higher. So, our view is that today's the last day of the month in the quarter and you have this news. So you're not really sure if we're getting rebalancing issues here or we're getting, people worried about the news. But as soon as they resolve this thing, or there's any news that comes out of it, this thing is going to rocket and we're going to get our 1 to 2 weeks rally. And then after that, we have another chart to show you that in case you guys were worried that we went all bullish on you. And Phil, let's talk seasonality because normally you get a pretty good sell-off into October's first 2 weeks, and then you sell off, then you really start ripping at the end. But I think everything's kind of pushed back a couple weeks. And so because of the positioning in the derivatives and this government shutdown worry, that I think we'll get a bit of a relief rally early, then we sell, and then I think you're going to look for people trying to get into the Santa rally. The only fly in the ointment, obviously, is when Yellen flips the T-bills to T-bonds and then or treasuries, then we have to see what kind of effect the liquidity does. But right now, I think we're still in the bull camp for a couple weeks.
Right. So like you said, we got to go down into actually the first week. Typically, you're going to see a bounce in October, then down toward the middle historically. We think, though, that we're going to probably have a chance where we actually run up because of the way that we're bottoming here at the end of September will give us an oversold bounce that can last up into the middle part of October. And then we may see a pullback down. And like Bob said, because of this year's a little different than what we've typically been seeing because Yellen kind of overdid it with the T-bills, and unlike any other year that we've ever seen. And that's why we've been rallying since the debt ceiling in June. That comes to an end. She can't do that anymore. They do have mandates on how many T-bills they can issue. And I think they're at like 23% of total issuance. So they're at their limit. They can't do any more per the mandate. So that's going to be very bearish for the markets. And that's why I think we're going to deviate from seasonality on the back half of October because as you guys can see, usually we lift off from that point. And I think a lot of people are just looking at seasonality and anticipating that, not realizing that under the hood, the mechanics this year are a bit different. So that could mean down into October. Now, obviously, November's bullish and December's bullish. So you have to kind of evaluate things after we pull back in October. She still has longer term debt to issue in November as well. We just have to see how much of the issuance she's gotten out of the way at that point. If she still has like 50% more issuance to get out of the way, then November is going to be a bearish month too. At some point, though, I think we're going to get a little relief rally, and that probably does manifest at some point in December. So if you look at bring back this other slide here, you guys notice when we go down 2 weeks prior, which is the case this year, it's always positive afterwards 2 weeks. And that's why that plays into what we're thinking too, Bob. So I think we're going to, we got some end of quarter, end of month. We said yesterday, I told people it's going to be volatile today. JP Morgan's got their collar roll, and I think that's what we're seeing today. Although the market's, making a higher low here. So I think it sets up for more positivity next week. Hey guys, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
Yeah, and look, here's the thing. I think the market's a bit of a hot mess. Here's the view. I won't speak for Phil. He can agree or disagree. But the way I'm looking at it is if October breaks the September lows, then I think we're going to set up for a better Santa rally than if we just keep chipping around here and just, stay in a range. Look, the earnings reports are going to come in weaker than normal because they haven't downgraded them like they have in the past.
Right.
And number two is the Fed was going to have a meeting and we're going to have another CPI report. CPI is going to come in hot. The math already tells us that. Whatever the Fed says in their next meeting is critical because if they pause, Phil, and we should talk about this, if they pause again, it really sets themselves up to saying, we think we've overdone it and economic activity is now going to fall off into their definition of recession. The market interprets that bearishly. And so we have three things that can make a market break seasonality. But this year, you have to respect seasonality. So, we're looking for a relief rally out of this government shutdown, kabuki theater. And then we're going to go into the first set of earnings, which I think will react negatively to the markets. And then we're going to have news, CPI and Fed. And then we're going to have to see how Santa goes. So for us, we're going to take it a week at a time. Right now, our macroeconomics is we see nothing that tells us that we're not going to keep sliding into deeper economic malaise. And then the stock market has no choice but to follow it at some point.
What's interesting about that pause too is that the Fed funds futures are pricing in a pause for November. I think they're at 85% likelihood. And if you go back and look, whenever you get two pauses, those pauses turn into that's it. That's the end of the rate hike regime. And then we go into cuts after that. So it's going to be very curious to me if they actually go ahead and pause, because to me, that's the Fed looking at the numbers down the line saying that, whatever, if they did hike in November, they'd have to quickly reverse course. And that's something they don't want to do for optics. You don't want to have a hike and then right away start cutting. You'd rather a couple of the meetings have consecutive pauses and then you cut, because then it looks like you know what you're doing. So I think that's going to be very telling. If I see that in November, and that's what the futures are telling us to expect, then I think we're heading into our recession scenario, which then also plays into our yield curve inversion, right, which has steepened. And once we go back to par on the 210 yield curve, that usually is your confirmation that the highs are in for this cycle in the markets. And then we've got, at that point, I think, Bob, we're looking at probably 80 more weeks. That's right, 80 more weeks of down before the market finds a bottom. So that's where you got to kind of strap in, and everything that we've been warning you guys over the last few months is really going to start to play out. And but there's ways to hedge that. We'll talk about that more as we get into that situation. But it's definitely lining up the way we've been seeing it, Bob.
Yeah, and look, in case people say, "What do you mean it's coming?" We've already had two lower highs. So if we fail to make a new high on this impulse, we're just still sliding down into where we think we're going to eventually go. Mm-hmm. And you know why I think, Phil, we pause and we don't go any higher? Because JP Morgan, Jamie Dimon said we're going to have 7% federal funds rate. And that guy, he's almost as bad as Kramer. He's talking his book here. He wants you to get goofy footed so he can steal your money.
Yeah, he's got a pretty consistent track record of doing that, the poker table thing. Look at Bitcoin. I remember, 2017, and that's when we were, really getting into mainstream crypto. And he said, basically that crypto, or Bitcoin specifically, was a joke. It was a fraud. Meanwhile, they were facilitating Bitcoin trades for the European customers, for the European clients. They were brokering Bitcoin trades. And now, obviously they're open and investing in Bitcoin actively themselves. So you're absolutely right. Whatever he's saying, he's just talking his book. I highly doubt we're getting to 7% because although the Fed may want to, the economy ultimately is going to trump them. And I think once that pause is confirmed in November, I think that's all you need to know. Yeah. That's it. I don't see any more hikes after that. So historically, that's what things tell us. That's how it should go. So we'll see.
Yeah. And people have been begging us, when's gold, when gold? When these pauses start to become reality and people realize they can't raise anymore, then you're going to see gold. And then after the sell-off, then you're going to see, Bitcoin take advantage of basically the change in the rate structure, because inflation is going to be higher than the rates. And that creates an environment where it's good for gold, good for Bitcoin, bad for equity. So stay tuned. We're just going to have to take this week at a time at this point and see how we get through this next earnings season.
I agree with you on the metals. Once that first cut gets announced, I think that's bull season for metals, at least in the terms of outperforming the market. once we go into the rate cutting regime, metals historically perform very well against equities. While equities may be making lower lows and lower highs, metals won't. And so that's where your metals are going to shine. And I think that's what everybody's been waiting for. It's just that it's a timing game. Your idea is right. You know, you guys that think that metals are going to be safe haven, it's going to come. It's just a matter of timing. And we're almost there, a couple months more. All right, guys, well, let us know what you think. Do you think that we are crazy, or do you think that things are going to play out the way we described them? I'd love to hear your thoughts. Thanks for watching. Please hit like and subscribe. Check out our specials and our newsletter over at tradegenius.co. We help you navigate these markets day in, day out, week in, week out. And we thank you for your time. We'll see you on the next video. Take care.
Trade Genius.